Hi guys, welcome to another video on cost accounting. Today we'll be dealing on cost volume profit analysis. Now cost volume profit analysis is an cost volume profit analysis is an application of marginal costing that seeks to study the relationship between cost, volume and profit at different activity levels and can be relied upon for short-term planning and decision making. Now, what cost volume profit analysis does is to help the cost accountant or an organization to know the cost of the product that they are selling or the service that they are rendering, the volume, that is like the amount of products to produce in a given period of time, and the amount of profits that they will get after putting all costs into consideration. Now, cost volume analysis helps us to get the profits from after deducting our variable costs from sales and deducting our fixed cost from the result you got after subtracting your variable cost from sales. The result you got when you subtract your variable cost from sales is your contribution. When you subtract variable cost from sales, you have your contribution. And to get your profit, you have to subtract your contribution from your fixed cost. If the fixed cost is greater than the contribution, it means there is a loss. And if the contribution is greater than the fixed cost, it means that there is a profit. But this is an example of cost volume profit analysis. We need to begin to solve this question. We need to know how to apply each formula in break-even analysis. We can call it cost volume profit analysis. So we'll kickstart our solving. So we start solving this question. So the question says that we're given the record from Toner Enterprise. So Toner is an organization. In the year 2024, this was the record of Toner Enterprise in the year 2024. Now they made a sales of 1.2 million naira. They incurred a variable cost of 720,000 naira and a fixed cost of 360 naira. They had a total cost of 3,000 units. Now the question is asking us to calculate the contribution per unit, determine the break-even point in units, calculate the contribution to sales ratio, calculate the number of units required to earn a profit of 240,000, determine the level of sales required to prepare a profit of 240 naira, calculate the margin of safety in units and in value if the budgeted sales are 40,000 units. The first thing we're going to do now is to get our contribution per unit. So to get our contribution per unit, we first of all need to get our contribution. I said earlier on that to get contribution, you have to subtract your sales from your variable cost. So the sales in our question, which is sales revenue, was 1.2 million naira. Then you subtract it from the variable cost. The variable cost in our question is 720,000 naira. So when you punch your calculator and subtract 1.2 million naira from 720,000 naira, you have contribution of 480,000 naira. Now we have gotten our contribution, but we have not gotten our contribution per unit. Now contribution per unit is each unit. The result we got here is the total contribution, not the contribution per unit. So in order for us to get contribution per unit, we will have to divide the total contribution by the total units that was sold, which is 3,000 units in our question. So when you divide 480,000 naira by 3,000 units, the result you have is your contribution per unit, which is 160 naira. So since we have gotten our contribution per unit, which is the first one, is 160 naira. Also note that I've given a formula which is our contribution per unit. So to get your contribution per unit, I'm giving two formulas. To get your contribution per unit, you get your contribution first, which is sales deducted from variable cost. Why? Once you get the total contribution, divide it by the total units that were sold, then you get your contribution per unit. But in a case whereby they didn't give you your total sales, they gave you the selling price per unit and they gave you the variable cost per unit. The moment you subtract the selling price per unit from the variable cost per unit, you have your contribution per unit because the sales and the variable are in per unit. So we are done with question 1. Go down to the next question. They say determine the break-even point in units. So to get the break-even point in units, which is BEP in acronym, you can use BEP or you can just write break-even point in units. So to get break-even point in units, you divide your total fixed cost or your fixed cost from your contribution per unit. And you see the reason why we got contribution per unit before we got break-even point in units, because we will need the contribution per unit in order for us to solve break-even point in units. So to get break-even point in units, total fixed cost divided by contribution per unit. So what's our fixed cost? Fixed cost was 360,000 naira divided by, what's our contribution per unit is 160 naira. Going to divide 160 from 360,000 naira, you're going to have 2,250 units. Now this 2,250 units is the break-even point. That's this 2,250 units. This was the point that the organization produced this amount of goods and did not make any profit or did not incur any loss for that period. This is the break-even analysis for units, break-even point for units. So we have solved for question 2. The next question says calculate the contribution to sales ratio. Now to calculate contribution to sales ratio, now we all know about ratio. When you say Bola to John is something like Bola divided by John. So which means to calculate contribution to sales ratio, we have to divide our contribution by the sales, which is contribution divided by sales, to get your contribution to sales ratio. So our total contribution is 480,000 naira. How did I get 480,000 naira? You know, before we got our contribution per unit, we got our contribution before we divided this by the 3,000 units that were sold. So the 480,000 naira that we got was our contribution divided by what was the sale for that period. The sales for the period was 1.2 million. So the moment you divide 480,000 naira by 1.2 million, you're going to have your contribution sales ratio to be, once you punch your calculator and divide 480 by 1.2 million, you're going to have 0.4 or 25%. Is either your answer is in decimal or in percentage or both of them. So we are done with question 3. Next question is question 4. So question 4 says calculate the number of units required to earn a profit of 250,000. Now that was the target profit. Now they are trying to ask you that, okay, how many units should be produced in order for the organization, in order for Turner Enterprise to get 240,000 naira as their profit? How did you calculate? So you know that's the targeted profit. So it's a target profit per unit. Since they are asking us to get the profit that they will make since they are asking us to calculate the amount of product that they need to get or that they need to produce in order for them to get 240,000 naira as profit. So our fixed cost for the period is 260,000. In addition to the target profit is 240,000. So what's our contribution per unit? Contribution per unit is 160 naira. So when you add up 260,000 naira to 240,000 naira, you're going to have 600,000. Then divide it by 160 naira. So the moment you divide this by 160 naira, the result you have is 3,750 units. So which means that the organization needs to produce 3,750 units in order for them to have a profit of 250,000 naira. So question number 5. Question number 5 says calculate the level of sales required to earn a profit of 250,000 naira. So this means that what's the amount of sale that the organization needs to make in order for them to get 250,000 naira as a profit. To get the sales, which is target profit of sales, it is fixed cost in addition to target profit. To get your target profit for sales, you add up your fixed cost to your target profit, then divide it by your contribution margin ratio, or you can call it contribution sales ratio, any of which is okay by you. Contribution margin ratio, which is our contribution sales ratio, in one of our solution, contribution sales ratio was 0.4 or 25%. So let's work with 0.4. So when you add up 360,000 naira plus 240,000 naira, you're going to have 600,000 naira. Then divide it by 0.4. So the moment to divide it by 0.4, the result you are going to have is 1.5 million naira. So which means that the organization needs to make 1.5 million naira sales in order for them to have a profit of 240,000 naira. The last question says calculate the margin of safety in units and in volume if the budgeted sales are 4,000 units. So to calculate margin of safety, the margin of safety here, they're asking us to calculate for units and also in value too. Now how will you calculate margin of safety in units and in sales? So margin of safety is budgeted units deducted by break-even point of units, which is BEP of units. So to get our margin of safety of units, what's the budgeted units? In our question, the budgeted unit says calculate the margin of safety and in value if the budgeted sales are 4,000 units. So which means that the budgeted unit here is 4,000. Then subtract it from what was our break-even point in units. Our break-even point in units was 2,250. So when you subtract 4,000 from 2,250, I'm going to have 1,750 as your units. You do the same thing for break-even form. Do the same thing for margin of sales. Same thing for margin of safety of sales, which is budgeted sales subtracted from break-even point of sales.